Well, good morning, everyone. My name is Mark Brownridge. I'm Director General of the Enterprise Investment Scheme Association. Happy New Year to you all. It's great to see you in 2021. We've broken through to the other side, as it were. We've gone through 2020. Thank God it's all over and done with. And we're into 2021. So fingers crossed for vaccines. My arms are ready for my jab, probably sometime in late September 2024. But hopefully we'll get to that point and we'll get through that this year. Very much for this particular series of webinars that we're doing that we've called New Year and Tax Year Ends as we head towards obviously the two big tax dates in this year. So January 31st for getting all our tax done and paid for, and obviously April 6th for tax year end. So I know for financial planners, accountants, it's a really, really busy time of the year. Lots going on, lots of client interactions. And I'm sure this being the first day of the working week for many of us, you're very busy. So thanks very much for joining us today. We're doing these webinars every day at 10 o'clock, so please do join us. Thank you for joining us today. Please do join us every other day this week at 10 o'clock. Every day is focusing on a different theme, different subject, and today's theme we'll talk about in a second, but I think it's far more important to introduce our panelists. We have 4 of them. Hopefully you can see them all on screen. So let's go through them one by one. Zoe, I hope it's not too sexy still to do ladies first, but Zoe, I'll go to you first.
Not at all. So yeah, everyone, lovely to be with you all today. So I'm Zoe, as Mark mentioned. I am a principal at the Octopus Ventures team. I'm sure lots of you are familiar with Octopus. So my job within that team is to kind of deploy both Titan VCT and our newly launched EIS Ventures Service product, which was only launched a couple of months ago. So much like probably everybody else and lots of people who you talk to, you're a big venture capital fund, focus on investing in early stage technology companies. Like lots of us here, SMEs are our kind of bread and butter, and we'll be doing more of the same this year. So thanks for having me today.
Thanks, Zoe. It's kind of welcome back to us for this year. So thanks very much for coming back to the market. Fred, over to you.
Morning. Hi all. Happy New Year. I'm Fred, co-founder and partner of Hatch. Most of you probably know me already, but if not, we have been around for 8 years now, operating as angel investors, and then launched our EIS fund just coming up 2.5 years ago now. So we invest in early stage digital companies across the UK.
Thanks very much, Fred. Paul, I'll go to you.
Happy New Year, everyone. Nice to see you virtually again. So I'm from Mercy Fund Management. We run EIS and we also have a VCT. We're one of the leaders in the industry, and we are a portfolio of 400 companies overall. And we're supporting some small companies primarily across the regions of the UK.
Thanks very much, Paul. And Justin, last but not least, over to you.
Thank you very much. Happy New Year, everybody, as well. My name's Justin Urquhart-Stewart, and last year, thank heaven we got rid of it, set up a business called Regionally. I used to run various stockbroking firms and investment firms over the decades, far too many decades, going back to pre-Big Bang. And really what I wanted to be able to do was set up a business which was doing some of the infrastructure, which the inefficiencies of the city and the financial services industry take away, which was actually not so much the regional stock exchanges, but encourage greater regional investments and the mechanism to actually not only invest, but be able to trade those shares regionally as well. So to encourage more investments into growing businesses in those regions. There's lots of demand for capital. There is no shortage of capital. There is a missing part of the pipeline which enables people to carry out that mechanism to be able to invest, to be able to make sure that they can actually then divest in due course and match up the investors with the companies themselves using corporate advisors and, of course, making full use of all the proper tax schemes. So that's what I'm there to try and do, to put back some of that infrastructure.
Impact. That's what we like to hear. Thank you very much, Justin. So look, I said there's a different theme every day. The theme for today is pretty much a very wide-ranging array of what happened in 2020, what's going to happen in 2021. So look, we all know, we've seen the graphs, they go like this and they go like this in terms of the economy. They're falling off the face of a cliff. That 2020 took a battering economically. We have major headwinds in terms of COVID-19 and Brexit. Yeah, we're still mentioning the B word, unfortunately. And it looks like that's going to continue into 2021. So we're looking to look back over 2020, see what the themes were from 2020. On particular focus, obviously, on early stage investing with EIS and SEIS, but also look forwards to 2021, see what we should be approaching for 2021, what the economic and investment outlook is for 2021, what the market's going to look like for EIS and SEIS, and also perhaps what we can expect from the government going forward. So probably a good place to start is with Justin on that one. Look, Justin, tell us what happened in 2021. Just how bad was it, and what's the outlook for 2021?
Well, it looks in 2020 as though we had the four horsemen turning up, didn't we? And it really did look a bit disastrous and appalling and very, very frightening. And of course, actually dreadful for people, particularly those involved in the pandemic and suffering personal losses. But yes, we had the pandemic. That was one of the first horsemen, and we had no idea really how to handle that. People have talked about it before, but none of us actually lived through it in this sort of scale. Seen it in the Far East, but never really in this sort of scale. Secondly, then, of course, we then have to deal with the second horseman, which, of course, was Mr. Trump. Sorry, President Trump, do I have to call him that? Not for much longer. And the danger that he has caused already and could cause in the next few days as well. Add to that, then, the globalization in terms of the geopolitical issues we were dealing with, whether it was Iran, whether it was what's happening in the Middle East, or, of course, the disputes with China. All those elements add to geopolitical threats as well. And then the fourth horseman, of course, the impact on the economy. Effectively, various areas of the global economy had a coronary and either had to be stopped, were stopped, had to be resuscitated again. And that's the process we're dealing with now. So a huge change. None of us have actually been through all of that combination. The good news is, as a result of those four horsemen now coming through, and assuming that is you don't believe the world is about to end, that actually we now can actually fight those very successfully because there are some very positive elements coming out of it. I find I have to try and negate what the media and often the BBC are saying the entire time, but there are some very positive elements coming out of it, not least of which we've got government money to be able to support this. Some of it's going to be funny money. There's a huge amount of personal cash sitting around at the moment, about the amount of saving going on, and there is a lot of dead wood and damaged wood, which has been swept out of the way. And that will allow investors and new businesses actually to be able to start with a damaged, but nonetheless, very interesting and fertile field to be able to work on.
And you said your Burmese cat might make an appearance, and it has done in the background there. So there he is. Now I know what a Burmese cat looks like. Thank you very much. So thanks very much. That's to kind of set the scene for us for 2021, and then also looking back over 2020. Just going into to the individual fund managers are here and the guys and girls running the investments. How was 2020 for you? What were kind of the themes that came out as we went through the year? Paul, I went to you last time. I'll go to you first this time.
Thank you very much. Yeah, it's been interesting times over the last year or so, and there's been, as you said, a lot of chaos really in the markets and across various different four horsemen, as Justin was just talking about. But actually, for small companies, there's been lots of opportunities as well, and that's something which we've seen quite a lot of. It's been very sectorial impacted, so you can imagine hotels and restaurants and leisure was negatively impacted, but there are actually some sectors which were actively positively impacted, and they tend to be the areas which we invest in generally, just not by luck, but that's hopefully by good judgment. And things such as kind of healthcare. So we do a lot in healthcare, and we do a lot in e-commerce and software, and they've all been nicely positively impacted, in fact. And we've had various companies have had very positive impacts onto revenue, which is a great sign. Another thing about small companies and EIS companies especially is that they're nimble. They can reposition themselves to what the new market looks like. And as Justin mentioned, taking out the dead wood means there's some opportunities for new, small, innovative companies to move into. And obviously, we will see a big growth in deliveries and all sorts of around e-commerce. And yeah, there has been opportunities as well as these big, dramatic negative impacts. And I think we're seeing that more and more. And as COVID develops and evolves and hopefully ends as the vaccine is rolled out, I think that the environment will change again. And I think the ability of small companies to be able to move and to be nimble across these changing landscapes is very important. And one of the benefits of EIS is that each time you do an EIS fund, it's set for the current world. So compared to VCTs and to a certain extent listed investments, they'll be investing into old companies which might have been suited for the previous environment. Actually, EIS is normally new companies which are being set up specifically for the current needs of the market. So it's been an interesting time, but there's been some big opportunities as well as some challenges.
There's definitely been those two things, opportunities and challenges, I think. Yeah. So just picking up on something that Paul said there in terms of sectors that, you mentioned that hospitality, retail, leisure sectors obviously taken a massive hit this year. I can't remember what his portfolio, whether you had too many investments in that area, but I'll ask a question next. Do you see that area coming back this year? And the fact that it's had a bad year this year means it might be a good investment because obviously it'll be up on the rise. And obviously also a lot of people talking about there might be a bounce back this year economically, talking about this roaring 20s economy that we might well see this year. Do you see that happening this year? Will you position your portfolios accordingly?
Yeah, I mean, I think Paul makes very, very true points. And I guess before I answer your question, just to emphasize that, I think the biggest learning for me was that people really are at the heart of everything we do. So the people who lead these businesses have really had to show, adaptability, flexibility, resilience, and they've had to make some really big choices, both in terms of their own lives, how they work, how they incorporate families. And it's been really impressive to see, actually. And so to Paul's point about how quickly they can reposition themselves has been amazing. So Octopus does have exposure to some sectors which obviously took a massive hit. So one of our amazing holdings is a business called Secret Escapes. We have a few travel businesses. And you can imagine that as soon as global lockdowns are imposed, those businesses have to, again, put in plan B, C, D. And of course, we're very lucky that we back brilliant CEOs, and so they can do that. But what we did see, interestingly, and to your point about, is this going to be the roaring 20s? So generally, lots of our companies took the view that they needed to buckle down for 18 months. This wasn't going to be a kind of 6-month hiatus. Let's kind of take a bit more of a conservative outlook as to how long it would take to fully recover. But during the summer months, when I don't know if anyone even remembers this, but when we weren't in lockdown and when people were able to escape again, we saw such a pent-up demand for folks, I mean, even the eat out, help out and so on, to go back out and to kind of experience life and to, have fun and do stuff that we can't even remember what it's like now. So what we saw, particularly with companies like that, is their revenue suddenly spiking very, very aggressively to follow this. And you can imagine that once the world opens, of course, those traditional sectors, I think, will once more have a boom. There will be some shift. I think, people have really adopted technology at a rate which, for investors like us, we kind of wish that they had, because where we've got exposure to other things like we have a business called Patch, which delivers kind of plants to people's homes, and where people were trying to make their homes a bit more attractive as offices, a bit more of a calming environment. Their revenues grew 3 times during the pandemic. So I think for every there are definite sectors who've been held back, but hopefully where there will be pent-up demand to push them forwards going into this year. But then, of course, there are other sectors, particularly in the science and healthcare space, or in the e-commerce space, where we're seeing adoption and, consumer behavior change at such a rapid pace that actually, within that diversity of a portfolio, you've got quite exciting things happening as well. So I'm very optimistic about kind of, I would say, as and when this happens, but do I think this is going to be the first kind of quarter or even half of this year? Not necessarily, but do I think that all of our CEOs probably took a longer term view than, then they're rarely over optimistic and they know how to plan, even though this is a unexperienced event. And that's the great thing about these SMEs. They are super, super agile.
Yeah, so that's probably good. I would leave a segue into Fred, because I know Fred works very directly with entrepreneurs and has done over the last year with what's happened with COVID as well. Fred, do you want to give us an idea of the kind of work that you do kind of day to day almost with some of the companies you invest into?
Yeah, I think before I answer your question, sorry, I'm quite good at that, I have to echo Zoe and Paul's points that, of course, there's certain sectors that have performed incredibly well last year. And from a Hatch perspective, we only invest in digital. So rightly or wrongly, that's the sector we invest in. And overall, we have been positively affected by COVID. To Zoe's point, completely, it's all about the people. And for us, it's about working with entrepreneurs. So the benefit we have of being a slightly smaller fund is that we spend a lot of time and energy and focus working with the underlying individual founders and, in many cases, their teams. And I think the number one takeaway from 2020 really is how every founder, every entrepreneur in our portfolio, and no doubt any fund manager on this call would say the same, has really pulled out, refocused, taken opportunities where they can. And I guess the best example of that is one company that was struggling a little bit in our portfolio because although they're digital, they operated in the travel sector. They provided a platform for luxury resorts, primarily in the Maldives and Southeast Asia, to handle guest experiences. So this is everything from restaurant bookings to scuba diving, so on and so on. And of course, the whole world shut down, and the Maldives shut down completely for travel, and Southeast Asia banned everybody. But working with the team, working with the founder, we made sure that they had enough runway and that they had the ability to go and land grab, and actually spent the last kind of, I guess, 8 months in the end of 2020, really focused on rolling out to new resorts, whilst the resorts were shut, and whilst the general managers and resort directors had the headspace where they weren't dealing with, Mark, who's unhappy because his steak was overcooked, and were focused on guest improvements that would be for the bounce back in 2021. So, overall, I think 2020 in tech was great and really driven by customer adoption faster than ever before, and enterprise roadmaps faster than ever before. All these webinars are on Zoom now. That never would have happened a couple of years ago. So there's really is adoption at no pace like we've seen it before.
So I guess kind of picking up on the theme that you've all mentioned there, there's been trends and things that have been happening for a while, but what COVID has done is really accelerated a lot of those different themes and tech advances, I guess, is what mainly happened over 2020 and probably pushing on to 2021. You mentioned the technical word then there, I didn't quite recognise, Brad. It was restaurant. I couldn't quite recognise the word. I haven't been to one of those from just as mentioned at the start, obviously we're heading towards January 31st, heading towards April the 6th, all big dates in the tax calendar for financial advisors and accountants. Another big date in the diary is March, so we're probably looking at a budget in March time. Obviously, there's a lot of talk around wealth tax being introduced, or CGT changes, or maybe changes to IHT. Everything seems to be on the board at the moment. What would you like to see? What do you expect to see from the government in a March budget?
Well, it depends if we're going to get some common sense out of politicians. Not exactly words that go naturally together, I have to say, but we're getting a bit more sense from some of the Treasury officials. It would make for very good headlines to say, let's increase tax, let's have wealth tax, let's adjust CGT and all those sort of things. But frankly, that's ridiculous. If the government wants to increase its tax take, you grow the economy. That's how you actually increase it. You don't just increase taxes, because as we know full well, actually they reach that stage with the Laffer curve where you are overtaxed and you end up getting less tax coming through. Yeah. Capital gains tax can actually be made far more creative than it is now, encouraging longer term investment. I know it was tried before, but actually done very ineffectively about 7 or 8 years ago. To really reward longer term investing. And that's actually what we want to be able to see, particularly in this country, because trying to get the government to actually focus on where we are successful as a nation. Manufacturing, we're still a manufacturing nation. We manufacture world's 8th largest manufacturer, but we don't really compete with Germany in terms of the origination of car manufacturing and things like that. I know we assemble a lot, that's not the point. Where we do have a lead is, of course, is in technology, as you've all been talking about, and the development of smaller companies in technology, and we've been very successful. Where we've been very bad at is not so much providing the finance for startup of those companies, but the second stage finance for those to get them to become middle-sized companies. All too often we find that they get scooped up by larger companies, often overseas, and then never see the light of day, which is why we have so few listings in this country. They go elsewhere. The London Stock Exchange doesn't work effectively with this. And AIM, which I have to say I was involved in starting 35 years ago, is now a pig's ear, and no more, frankly, than a benefit if you happen to die and get your inheritance tax relief.
Your fault, Justin.
Exactly. So I would have changed all of that. But the point is this, that actually what you're going to be seeing is, I think probably, if the government's got some sense, constructive tax regimes here, which actually encourage greater longer term investing to be able to do so. The government has no immediate pressure to pay down debt because of the joys of quantitative easing, which is wonderful, isn't it? Because of course you go back to the economics books when I was having to do my economics exams and things like that, it didn't exist. But of course, actually being able to produce your own money, if you've got a reserve currency, is very helpful indeed. But there comes a stage where you lose confidence in that, and that fiat money becomes worthless. We're not there yet, but the government can increase a lot of debt, reach levels which are almost eye-watering, but can manage it down again, so long as, remember the one word that runs any economy, you maintain confidence. and the confidence that is the economy can grow, and that actually it will actually then produce tax income, which will be able to manage it. In the longer term, that debt has to be managed. This isn't just a British issue. You look at something like Japan, where effectively the Japanese bond market is now the Japanese government. Japanese government have been buying equities and corporate bonds and actually physical assets as well. The Americans have been doing the same. You can carry that on for a while. So there's still some room here. The question that we've got is, leaving Brexit aside, do we have the ability to attract enough inward investment coming in into new propositions, I say not for startups, but to grow those businesses through? And for that, they need to be able to have enough confidence that the British economy can actually not succeed and thrive outside the EU, and to be able to develop. And that's going to take political leadership. I'm not too sure we've got that at the moment, in which we gets a great deal of confidence, but also demonstrate that economic growth. So it should be a constructive budget. A taxation budget would be stupid, and I get the impression from the Treasury that they're actually realizing that. So fingers crossed, keep pushing for that.
Yeah, I mean, you mentioned the D word in terms of debt. Obviously, we've seen a lot of debt go in with C-bills and bounce backs and the various other schemes that have been in place. They have all been debt-based. Do you see a role for equity coming into kind of riding to the rescue a little bit here?
I think there's going to be an very interesting issue here. And again, forgive me talking my own book with regionally, I see a conversion from debt to equity being very useful here. We haven't really tapped the ability for regional and local investors to come in, and our angels have been fantastic there, and obviously investors into VC funds and regional funds as well. There's more we can do into that, particularly to make sure you match the quality of investors, the right type of investors, into right businesses. You can manage the shareholder base you want to have. Is it family? Is it staff? Is it suppliers? Is it even consumers? And then what is so crucial is actually making sure not just another investment platform, but an investment platform which in due course you can sell out of. We have more platforms in this country than Network Rail. What we need to be able to have is a platform where you can actually trade into and then trade out of, not as a daily trading mechanism, but as a mechanism where quite often with things like matched orders, you can be able to do that and create not so much, you won't create great liquidity, but the ability to let investors know there are exits for them at the appropriate time. And that's when you create much greater investor confidence. So again, encouraging governments towards that, towards medium-sized, small-sized businesses to enable them to be able to grow. EIS is fundamental to that. CGT can assist that as well for the longer-term investors outside those schemes.
Brilliant. So Justin set out his manifesto there. Thank you very much, Justin. Zoe, I'll go to you. In terms of kind of changes in the budget, are you expecting anything at Octopus? Are you hoping for anything?
So I think, I mean, just speaking very much as a fund manager and someone who works all the time with entrepreneurs, so this is literally through a very specific, not necessarily wider Octopus. I mean, again, echo lots of what Justin said in terms of long-term and patient investment and wanting to encourage that. I think from an entrepreneur's perspective, the thought of the rumours to the capital gains regime changing or becoming equivalent to income is horrifying. So we spend a lot of our time, you know, obviously working with early stage founders, encouraging them to kind of take this risk, to often have very low salaries, but with the hope that the equity that they, you know, put in to kind of take off the table in the business will eventually be worth something great, and to grow that, you know, that cannot be kind of taken away, because as soon as you do that, you cut the knees of the economy into something that which we really, really believe in, which is you kind of fueling the early stages. And then to Justin's point about growing that and seeing that through the cycle, the other bit, which is not really to do with the budget, but which overlays quite a lot of this, which is wanting to attract more capital all the way through the stages, so that we become far more like the US is with technology businesses, all the way through to whether it's an IPO or an exit. We also have this kind of overlaying NSI bill, which is where the government is obviously trying to kind of in-house or keep some of our best technology assets and other assets kind of within the UK, which again, very supportive of at large. But what we want to make sure with all of these regimes is that fundamentally we are stimulating growth, scale up, capital staying within this, more jobs, and then kind of keeping it within the UK and Europe for as long as we kind of possibly can, but without, you know, putting off entrepreneurs at the earliest of stages, putting off capital coming in from other countries, and then like preventing exits, because fundamentally it's our job to kind of realize and return that capital to our kind of shareholders and to our investors, and we want to support that all the way through. And there's no point in us being this beacon of technological excellence, which we are in Europe, and having all of that, if we don't then put everything in place to support it. So for me, I guess my biggest one that I stress about is the thought that I might want to back an entrepreneur who, you know, I want to do the full journey with, and then that they might be cut off at the knees in an exit scenario. That's really not great.
Yeah, it seems very odd that we're the government constantly talking about helping entrepreneurs, helping small businesses, and taking them on that journey, but they get nothing on the way in when they start a company and set up a company. And now they're talking about getting even less or perhaps nothing on the way out. So where's the incentive there as an entrepreneur to start up and scale up and grow a business? It seems diametrically opposed in that sense. But Fred, just coming over to you. Zoe's very eloquently put across the case for entrepreneurs. In terms of kind of investors or you know, financial planners watching, what would you like to see if you were kind of one of those guys or girls?
I think I have to echo the comments that have already been said, and I think Justin mentioned this. If we overtax or don't incentivize, then people will go elsewhere. That's entrepreneurs and investors themselves. Look, we're an EIS manager, right? We're all EIS managers at ESA. So of course, EIS is extremely important to the UK economy and something that we all lobby for improvements to and speak very highly about. And our experience with financial planners is it's incredibly important to their clients as well. So I think broadly, improvements on EIS is always going to be something that you're going to hear from an EIS manager when we talk about budgets, and whether that's improvements to top line numbers like tax relief, or to more intricate policy around when you can make those investments or the type of investments you can make. I think that's always something we're going to lobby for. One of the big gaps I think that we missed in last year where EIS struggled was around, the government launched the Future Fund scheme, came out of COVID to support with debt, which can convert into equity alongside other debt. And as an EIS manager, it was almost impossible to work with because we can't do convertible notes. Maybe we do advanced subscription agreements, but there's so many limits around them. So I think any government initiatives that are launched this year or in the future around supporting venture and supporting entrepreneurs in the UK, it's our job as members of ESA to make sure that they work for EIS as well. And I think that's a big gap and a big challenge that we saw in 2020.
Yeah, and Paul, turning to you lastly on this point, obviously there has been changes in EIS back in 2015, back in 2017. It has been quite an unstable period in terms of changes gone through and patient capital review, et cetera, et cetera. What would you prefer to see? Changes made now, kind of fundamental changes, or a bit of a period of stability and calm?
I think you probably preempted my answer there, Mark, because I was going to say I prefer to see no changes than anything else, because I can see when the government's giving out money on the C-bills and such, and it's going to be actually increasing the amount of tax relief is going to be probably not attractive to them from my perspective. I think it might give the wrong sort of message, tax breaks to the rich and supporting businesses from the C-bills and other schemes. So I think the best thing we can think about at the moment is just to have some stability. I think the capital gains tax changes to that, so the marginal rate would be, from an investor's perspective, pretty worrying, and I think that might even reduce the amount of money that's going into EIS in the short term. But I'm not sure that's the right way to approach it, partly because the deferment of CGT from EIS is a very useful tool, and I'm sure all the planners know about it and use it regularly. But having the combination of income tax, loss relief, which loss relief is not talked about enough from my perspective, in addition to the CGT, it creates a very powerful package. It's specifically set up to enable investors to go into very early stage companies and have downside protection, which is fantastic. And then, as Justin was referring to, the issue with the UK, it's not about the early stage investment where SEIS and EIS are there supporting the formation of small companies. It's the scaling up stage, going through from the S to the M. So moving the check size up and growing these businesses to global businesses, and then hopefully IPOing or selling them at high value. and again, that's something which you need different pools of capital for, and EIS is somewhat limited, SEIS is very limited. Having a VCT alongside an EIS manager is helpful, such as Octopus and ourselves do. Then having VC, venture capital investments as well, which can follow on and try and keep supporting entrepreneurs from a very early stage all the way through. That's what we need, and that's what's kind of lacking in the UK at the moment on the grander scheme of things. But EIS has its place, and it's very important. And I think it works for both the entrepreneurs and the investors, and hence the planners. So I think in the new world, EIS has a very interesting and opportune position. And just I'm praying for no big changes to DIS, to be honest.
Yep. So keep calm and carry on. That'll do the job. So it's really trying to build that kind of conveyor belt of money for companies all the way from early stage and taking them on through to SME stage and hopefully onto the unicorn stage as well. That's where we are at the moment in terms of that. I just want to ask you a follow-on question for, if I may. Obviously, last year we saw falls in investment in EIS and SEIS. It's a risky investment, as is well advertised. And risk was the first thing to come off the table. Obviously, it makes sense that you don't want to make your riskiest investments a risky period of time. How do we kind of tease back those nervous investors? Are they starting to come back already? We're starting to read again about people have hoarded cash over the last year and have money piled up under their beds or under their carpets, et cetera, et cetera. Do you expect to see this year being kind of a bumper year for EIS and SEIS? Or is it still a little bit rocky? I'm just trying to get a temperature check, really.
Yeah, and for us, actually, this year has been better than last year, which in some ways is a bit of a surprise. But I think that there are some factors around that. As I say, we are investing into sectors which are being quite positively impacted by COVID. So you can see valuations going up nicely. And some companies have actively benefited from COVID. But one of the EIS companies, revenue increased 5-fold. And one of the non-EIS companies, which is a bit of a shame at this one, but one of them was budgeting a revenue of 100K in April and actually achieved 8 million. So 80-fold over budget, which it's going to be the right place, the right time, and that's fantastic. So there are opportunities out there, and I think we'll see. It's always going to be changing the landscape in which we're operating. But the ability for small companies to be nimble and move into the niches is very important. I do think we'll see more EIS money coming into the market this year, and I think it'll be progressively growing over the next few years. And EIS is exactly the sector and stage in which the government needs to be supporting to enable the growth of GDP that Justin was talking about, which then enables us to not have these big deficits going forward. I think it looks okay for us this year, but I think in the future it could be very good.
Yeah, I'm saying the same with you, Freddie. You're expecting a kind of busy next 4 or 5 months as we head into April time?
Yeah, absolutely. I think there's lots of talk in the market about investors taking risk off the table, but you only have to look at the US stock market over the last year, especially in tech, or the Bitcoin price, which reached $34 and a bit $1,000 yesterday. Or to bring it back to EIS, we look at our fund, and last year we raised more than we did the year before and the year before that. And this year we expect to do the same. So I think there are, of course, investors taking money off the table, but I think the sophisticated investors and planners are pouring money into opportunities because they're seeing this as one of the greatest opportunities in any of our lifetimes to get into tech and to invest and launch. So absolutely, we expect good things for 2021.
And same for you, Zoe. I guess, again, if you had a message for financial planners, advisors at the moment who are looking, again, towards 31st of January and 6th of April, what kind of calming, reassuring messages would you be putting out there at the moment?
I mean, I obviously wouldn't be telling them how to do their jobs or suggesting any kind of financial promotion, which are not.
Or taxes.
But what I would say is that when we look at history, it's taught us that whenever the market suffered a massive shock is actually a great time to go almost into the riskier end of the market. And with a lot of these investments, both they and their clients will appreciate that they are longer term. So they are not going to be looking to get liquidity in the next kind of 3 years. It is a far more patient outlay of capital in any event. So is it a great chance to be sitting alongside kind of, you know, some exciting new startups when there is a great time to be getting in, when, you know, valuations may have suffered, but in our favour, where equity has got a great chance to grow, and where all the businesses which everybody kind of sat here invest in, so technology first, are really riding a tailwind of, you know, a consumer who are kind of adopting this massively? Yes, I would say so. And of course, we're seeing, yeah, really positive uptake of the VCT. EOS product is kind of newly launched, but again, it's exposure to these businesses which really do grow at a rate that you can't really be paralleled in other places. So if you're building any portfolio, if you're advising any client, you always look at diversifying it. And as part of that, I think, you know, what is considered the riskier end of the asset class, but where you will be stimulating the UK economy and doing your bit as well to kind of bring it back, that's an exciting place. And obviously for us as fund managers, we would, you know, of course, say that that's a sensible place to be putting money. When we look at 99 and 08, you would put that this year as the same as those, and great time to kind of invest.
Yeah, thanks so much. I should have said at the start of this webinar that if you have any questions, please do use either the question and answer function at the bottom of the screen or the chat function. Where are we? 10:37, so we've got about 20 more minutes. We have loads more content, don't worry, but if you have some questions, please do fire them through. I want to pick up, Justin, on two things that Zoe mentioned there, was diversification and risk. I'm not sure if you know much about these two things, but certainly on the risk side of things, give us your kind of view on risk in general, because I'm always interested to hear what people's definition of risk is, or philosophy on risk is. It seems to vary pretty much from individual to individual. So I just wanted to get your take on it, really.
I always find it funny when we have to carry out a risk assessment for clients, and therefore you have a risk assessment of 3, 8, whatever it happens to be, it doesn't really matter. And the truth actually, of course, is you don't have one level of risk. You have actually a series of levels according to what you want to try and do. And most of us will have a pot, which is, for God's sake, don't lose the sodding stuff, through to some risk, through to I'll have a punt. And so long as you separate those out, that's okay. And I think good financial planners do precisely that. When you're looking at markets like this, and you're looking at the level of risk, well, certainly one of the big things for main markets at the moment is actually that's always not timing the markets, time in the market. Had you actually stayed invested in the market last year on a broad range of asset classes around the globe, with compounding of returns, you would have still been all right. It would have been frightening during the process, but for actually in the longer term, perfectly okay. For medium-term investors, you would have actually had the chance of being able to sit there and say, I've got some cash, my heavens, look at what's happened to the market. It's suddenly dropped dramatically. I could take advantage of it. And many people did by buying nothing particularly risky, but just buying into some ETFs at low levels. But also then maybe our end of the market here, dealing with smaller businesses, being able to actually not so much pick up the small businesses that are exciting, but actually seeing after the disaster what actually the market then looks like. And we've already highlighted it today in terms of technology, but also add to that the environmental issues of ESG, the issues in terms of assets which are going to be left over after private equity businesses have blown up, which we've seen quite a few of. And so the whole new market, which will throw up, I think, some fantastic opportunities. So those different levels of risk are there. And I think what we also have to do as an industry is then make sure that we are, again, trying to innovate new ways of making sure that people have access to this risk in and out again. We're very good as an industry selling products to people, but you need to be able to make sure they have a mechanism for coming out. And that's what we've not been so good at. After all, we say to businesses, well, after a while, you're going to IPO. To where? There isn't a proper market to IPO to. As I say, AIM should have an L in front of it. It doesn't work. It's too expensive. It's very badly run, and goes away from what it was originally supposed to be doing. You've got other ones slowly coming through, but we have to press and develop more opportunities like that to enable greater, if not liquidity, certain trading, and the ability for companies to be able to see a future beyond the good investment we're providing with now. So risk must be measured. There is no one single element to it. It breaks it up according to different people's attitudes of mind. And so long as we're well aware that we're not misleading people, then that's right. And we need to be very careful of that. But good financial planners do that anyway. That's encouraging.
Yeah, and I guess on the point of liquidity that you're making there, yeah, it would be hard to create, I guess, a secondary market or in this area. But I guess what we can do is make sure it more frictionless and take out some of the barriers. That would make it a lot easier to find some of that.
It would indeed. For example,
liquidity.
Yeah, companies over a period of time will know that they will have events coming up. And as long as they tell investors in advance what they're planning to do. So on a 5-year plan, I may have another capital event in 3 years, 5 years' time. Remember, the typical average equity investment period is 5 to 7 years, not 3 years, as private equity often looks at. That's far too short. That's not the investment cycle. So you tell investors that's the period you'll be having. How you then actually create a trading mechanism is by matched order. Don't try and create a mechanism with having market makers and things like that. It's far too expensive. You're trying to reinvent old-fashioned stock exchanges. It's been tried before. It doesn't work. So this is a simpler way of trying to do so. It's not perfect, but we know how that operates in the States perfectly successfully, and we can try and do it here. Unfortunately, with the very London-dominated market that we have, the ability to try and get people to change, the larger operations change, is actually very difficult indeed. But no, it will change. It has to, because actually there's more demand coming through. As I say, put back some of that financial plumbing, you'll be surprised how easy it is then to use.
Yeah, absolutely. I agree. In terms of that investment cycle, Paul, Justin was talking about that 5 to 7 years. Is that pretty much what you tell clients in terms of how long all this is going to take? And also just on the risk point as well, just expanding that out. How do you explain the risk of investing in an early stage company?
Yeah, again, it's just been stolen my thunder. So 7 years is exactly what we state to our investors in terms of timeline. And actually, it's a good example last year, 2020, which is last year now. We had we had quite a few exits last year. That's a point we come to on later on. But we had a couple of 8x exits for our EIS fund. And one of them was in 7 years, which is the end of our timeline, expected timeline. And then one was in 2.5 years. And we had people complaining about both, actually, partly because 7 years is a long time, but also 2.5 years was within the 3-year period for EIS. But I think that's kind of the bookend of what we expect, and 5 to 7 is more realistic for the kind of exits. And we do already create broad portfolios, so we're talking 12, 15 companies per fund, so which does de-risk the overall fund performance, because we do expect some winners, but the diversification aspects means that we can also cope and do expect some companies to fail, hence loss relief is relevant. I think actually last year, 2020, we saw an awful lot of corporate interest in M&A. There was a lot of approaches for our portfolio companies last year, more than we've ever seen before. And that in some ways does align with what was being said earlier around corporates and private investors being quite restricting their cash spend last year. And hence they have some money to deploy, whether it's into private investors via their financial advisors, or whether it is corporates who are repositioning themselves. They're looking, big corporates looking at what's going to happen next. They see that there's a gap in their service proposition, and they think, okay, so we need to acquire a business in this space to move into that space quickly. And they've been looking down into the smaller SMEs and spotting companies across EIS and other sectors in which they can acquire. And that's been great. We sold 5 companies last year over 8 times cost across the group. And I think that's the kind of pace that we should expect going forward. And I think it's going to be, I think, as Justin was saying, recycling capital, the selling as well as buying is really important. And giving liquidity to the unquoted market is very challenging, but I think some fund managers have the experience of delivering exits, and that enables investors to have more confidence.
Thanks, Paul. Zoe, I know you need to leave, so I'll let you go on about your day, but thank you very much. And you'll be back tomorrow, I think, for our fees and exits webinar at 10 o'clock.
I shall, which will be picking up precisely on Paul's.
Yeah, good segue. Absolutely, yeah.
So beautiful segue. No, thank you all very much for having me today. And I'll see the folks who are on tomorrow, but nice to see you guys on the webinar. See you soon.
Thanks, Zoe. Take care. Just picking up, because we do have a question that's come through, so it's quite a pertinent one, so I'll throw it in. So The question is asking, will quality in tech launches be compromised? Furthermore, will investors being keen to commit to such opportunities and an extra due diligence and mitigation of obvious conflicts of interest being put into place, but also to avoid oversaturation and necessity to invest within restricted timeframes, making it more difficult to avoid poor opportunities? I guess that kind of simplifying that question a little bit. And Nick, please tell me if I'm wrong, the person who asked the question there, Nick. Basically, if more money has come into this sector, is there a possibility that you're just going to throw it at every company that comes along and just basically get the money away as quickly as possible? It don't really matter about how the companies are, whether they're successful or going to be successful. You just want to get that money invested, and quality therefore goes down. Would that be a fair comment? I'm assuming not, Fred, but I'll go to you.
I think there's some investors in the world that want that. They just want tax relief quickly, and they don't care. And I think in the old world, that was that happened a lot. I think EIS has been reformed and changed, and there's been a lot of focus on making good investments in good companies. We are receiving more deal flow than ever before. So I would say, yes, there's a lot of tech launches in the market. There's lots of companies that are launching. Also, the barrier to launch a business now has been, is a lot easier than it was 5 years ago. The technology platforms are available to launch something, or the ability to make yourself look bigger than you are, means that there's lots of opportunities in market. Our job as fund managers remains the same. We need to pick the best of what we see. And for us, personally, that means seeing a couple of hundred deals to make 4 investments. So I would say we're pretty selective. Our DD process in terms of what we do continues to evolve, but really for us, we're product people. We built and exited a retail digital e-commerce company successfully to Morrison's, a supermarket in the UK. And we've always remained as product people. I like to touch and feel. So even if it's digital, I want to get my head around it. I want to understand how it works. I want to put myself in the customer's shoes, which is how we've run our businesses before. So of course, we have to do DD. That's our job. We have to understand the companies at the end of the day. There is a lot in market. There's a lot of rubbish in the market. And that's why, you speak to any entrepreneur that's raising money, they speak to a lot of funds before they raise. They go through a lot of DD. So I think the good funds, of which I think everyone on the call is, do the DD right, and
Can't say anything else, Fred.
Don't just spray and pray. That would have been awkward if I said something else, right?
Exactly. Yeah, I'm going to pick up on a point there you made, actually, because you said you see 200 companies, I think, and you select 4 for investment. But assume you wanted to raise, I don't know, £2 million between those 4 companies. What if you raised £8 million and all of a sudden you've got an extra, I forgot my maths, £6 million to invest? Have you got another kind of 2 or 3 companies lined up ready to go? But then they weren't the ones in your original 4. So yeah, I guess it's
a
just
great
trying to understand the process, really.
It's a really good challenge, and it's the thing that I hate most about the end of tax year kind of regime, I call it, for EIS funds, in the sense that you can find yourself in that predicament. And there's a number of ways to solve that challenge. You either cap how much you raise, you have more opportunities, or you have flex built into opportunities. And I think the flexibility built into opportunities is interesting. And I don't mean flexibility in terms of giving companies more money for less, or the same valuation, or increasing the valuation, but more around probably 9 out of 10 deals we do, there's other investors. So we invest alongside other EIS funds, other angel investors, other VCs. And those funds often have the ability to flex how much they do, and we have the ability to flex how much we do. So for us, a typical investment round may be up to £1 million, and typically we do 250 to 500,000 of that. We have the ability with those founders to increase our proportion of their round or not, depending on where we are with the tranche. Of course, the other point I'd make is that there's follow-on opportunities as well. So something that our investors are always keen for is follow-on opportunities in our portfolio. And we tend to do a handful, maybe 3 or 4 follow-on investments a year. And there we have a bit more scope in terms of how much we can invest. But ultimately, we want to stay true and make investments at the right price for the right amount of money, and not just deploy because we have to.
Sure. Justin, you look ready to burst and want to ask a question.
No, Fred, Right there, the whole benefit of a tax incentive scheme is it is an incentive. It is not a reason for the investment, but merely the incentive to assist with the investment. The underlying investment must be strong enough on its own feet. And I think this is one of the issues that we've got to look at. EIS is great and SEIS. However, the investment gap tends to, I've found, between 500,000 and 15 million. That's very difficult, because anything below 15 million, the institutions find it difficult to get into. Some will, but often don't have the ability, and often it's too expensive, but also it's too big for angels on their own, or some of the funds to do it. And as Fred was saying, they would coordinate together, and that's the way they can try and do it. One of the things we've been looking at is actually trying to make sure there is more focus on that broader range of 500,000 to 15 million, bigger level of funds to go into larger and the next stage of investments. The lower end is often quite well funded. That middle bit is really very difficult to do. And that's something which as an industry, we've got to spend more time trying to focus on to help businesses through that. And that's where all of us, whether they're funds, whether they are VCs, whether they are angels, can coordinate together. And certainly that's what I'd like to see, hopefully regionally can try and help with some of that to give us those larger scale funds and not find ourselves in a position where we've got funds desperate to try and get into small businesses, but rather don't be afraid. Let's have a larger sum going into larger businesses to help them grow to the next stage.
Yeah, it's probably a good time to bring Paul in, because I know Paul's got some experience in kind of in meeting some of those gaps. It always seems to me, Paul, that there is capital out there, as Justin says, but it's not very good at working together. We kind of work in silos a little bit and don't talk to each other and don't collaborate and don't co-invest perhaps as much as we should do. But I know kind of Mercia has done that with Northern Powerhouse investment funds and other government available funds as well. So perhaps you could talk about your experience of how that has come together.
Yeah, so over the last 5 years or so, Mercia has evolved from a small EIS manager into having about almost $1 billion of AUM, involving EIS still, but we also have VCT from Northern Ventures, Northern VCT. They've got 320 million, and we've also got the British Business Bank money, which were regionally focused funds, the Northern Powerhouse, the Midlands Engine, Northeast Venture Fund, and there's probably about 300 million of regionally focused money from the government. And what we're able to do is basically leverage our EIS investors against both the regional funds, so the British Business Bank, but also the VCT. So we can put together, we could do a small investment as 100K in companies, but we could also do as large as 10 or 15 million. We wouldn't do that as a first round. We would basically put small amounts of money in first until we get comfortable, and then progressively increase through the rounds. So we can go from C to probably Series B, participate in Series C. I think that's one of the gaps which is out there, and building companies such as ours is something which we've recognized, especially in the regions outside of London, that there is this gap, and we've grown the business to be able to help try and fill it. Partly because there's a great opportunity out there. We see 3,000 companies a year. We want to see more. We invest in probably 2 or 3%, maybe even less than that, across different funds. There's great opportunities outside of the Southeast which are not being accessed. And I think there's a lot of capital, both VC and EIS and VCT, which is being invested into London, partly because it's easy and there's lots of deals. There are lots of companies there, but there is a lot more money than there are companies. Whereas in the Midlands, especially in the Midlands, there's not a lot of capital going into companies, but there are a decent number of good high growth companies. So we have that ability to deploy capital at the price which we think is appropriate, rather than ending up into this basically upward spiral of money chasing a few companies, which we see in London. That's one of the major reasons that we do not invest that much in London. It's not because there's not great companies, but it's the pricing of the companies. And you need to get in at a good price, to get out at a good price, to give the investors the return. And it's as simple as that. And having the ability to use different pools of capital, it obviously does create some complications. Pricing is the obvious one between different funds, but I think it's working quite well, and I think you'll see over the next 6, 12, 10 years that we'll be continuing to grow.
Yeah, that's good to hear. I think Robert makes a good point. You're doing your best impersonation of Blofeld there, Justin. So thank you very much. This is the beauty of a Zoom. You wouldn't get this at a physical event, would you? So seeing someone in their own home with their own animals and livestock and cats and dogs, etc., etc. This is the beauty of Zoom. We've got about 5 minutes left. Don't have any more questions coming at the moment, so I'm going to end up giving you a kind of a free rein here. So let's imagine we're sitting here this time next year. Where are we? 4th of January 2022. We're looking back over 2021. What would you have liked to have seen happen this year? What do you hope that kind of 2021 this year? Justin, I'll go to you.
Okay, well, let's first of all hope that the vaccines have worked. Good news, vaccines. Bad news, there are going to be further variations and strains coming through, but overall, it's been better for the global economy. And so we've managed our way through it. That's an encouraging sign. Good news is that we've now had an economy which is now picking up. The politicians will say they've never seen growth, anything like it, but it's hardly surprising because you've seen such a dramatic drop. Realistically, you'll see recovery growth as much as anything else. The question is going to be for Britain, what level of confidence, as I was saying earlier, can we achieve being outside the EU, and do we create that confidence for inward money coming in? But don't wait for that. We've got enough domestic money that we could be using in the meantime. So I think that's encouraging. I also think that actually what you're going to be seeing is a lot more consumer spending coming through because the confidence will be there. And as we saw last year, just the slightest chink coming through that actually markets open up a bit, go out to spend, people will do so. The high street has changed dramatically. It's not going back as it was, but there's still going to be a high street. There's still going to be a huge amount of retail, but it will be of a different shape than before. That will provide us with some great opportunities. The technology, our advantage that we've got, I mean, you have to look at our centers of, whether it's Silicon Roundabout, Beach, Gorge, all the various names we like to give it. They have been very successful indeed. Now, I hope government will actually provide us with more support, not so much in money there, but in infrastructure, making sure they've got the proper high-speed internet access right the way through. Some have, some really don't have it, and making sure that's there. If that we can have most of that coming through, that'll give us a lot more confidence and put the British economy in a much better position, obviously, than now, but in many ways a better position than actually people would say for the rest of the EU, which is more of a controversial thing, and particularly for someone like me who is much more of a Remainer.
Yeah, thank you very much for your piece there, Justin. So, Paul, yeah, same question to you, really. We're looking back on in a year's time. What do you hope to see from 2021?
Might be a bit controversial here and talk about EIS specifically. I would like to see progressively people investing for the right reasons. So there is a lot of tax planning that goes on in this industry, and I understand the reasons for that, and the tax incentives are very useful, but fundamentally, the new world of EIS, post-patient capital, needs to be about the investments. And fundamentally, we are, Mercy are investment-led, which means that we deploy over 12 months. So it's not slow compared to the industry, but we are very much focused on supporting the best businesses in the regions rather than just focusing on that tax year end date, which it does come up a lot. And I think that's an evolution which I would like to see specifically. That's one of the aspects of EIS, but also probably more importantly, I would like to see EIS fund managers returning more money than they're investing and they're receiving investment. So you might raise 10 million a year, fine, but we want to get to a point where we're returning 15 million to investors. And at that point, it becomes a mature environment where you can see cash coming in, cash coming out on a regular basis. But at the moment, many managers, they have had very few exits and they're not able to point to a track record. They can take money and invest into companies, but they haven't actually realized value. I think that's something which will happen in time, but I would like to see the EIS industry mature into something which is more functional and having regular exits and giving cash back to investors on a regular basis.
Yeah, I think a lot of investors, a lot of financial planners and financial advisors watching this webinar probably echo your words and wishing to see more exits. So I think that's fantastic. And also on the investment point as well, yeah, I think we talked about the tax side of it for way too long. We need to talk about the exciting, growing companies, and we've seen it over COVID over the last year. COVID's been really a microcosm for kind of 3 or 4 or 5 years, all in 1 year, effectively, to how companies can grow and how they can go the other way as well. But it's a good example of how a portfolio of companies, early stage companies, can work. And think for my money, going forward, there's going to be some really, really exciting companies that you guys are investing into, and this is your opportunity as an investor to get on board at a very early stage and go on that journey with them. So yeah, the investment story is a great one. So thank you. Good, two good ones there. Fred, the final word's going to go to you because we're going to clock off at 11.
I think Paul stole my thunder, which was going to happen at some point. I couldn't agree with those 2 points more. And I think as a relatively new or emerging EIS fund manager, it's even so more important for somebody like us that is making a name for ourselves and proving ourselves in industry. So for us, it's about exits. For us, it's about making the right investments. We talk to investors about investments, not tax relief. Tax relief's a bonus. And actually, as an EIS fund, about 20% of our fund is non-EIS, which I know sounds a bit weird, but we have investors who are not eligible for EIS investing because they buy into what we're doing, which is exciting. I think the big thing we're focused on this year, of course, is exits. Of course, is increasing our AUM, which is great, making great investments. And also our angel portfolio, which we've built under Hatch, is really important to us because for the last 7 years as angel investors with exactly the same investment thesis, we've invested our own money into exactly the same stage and type of companies. And we're starting to achieve exits off the back of that right now. And that really kind of echoes all of those points, I guess, and underpins them all. So 2021 is going to be exciting. And hopefully this time of the year, we can do this webinar, but in the same room. Maybe on a beach somewhere warm.
Wow, wouldn't that be good? Yeah, fingers crossed for that one. So thank you very much, Fred. Thank you very much, Paul. Thank you very much, Justin. Thank you also to Zoe. You obviously left us a little bit earlier. It's been a great start to the new year. So thank you very much for joining us. We're here again tomorrow at 10 o'clock. We'll be dealing with fees and exits, which we've covered somewhat this morning, but we're going into far greater depth on that tomorrow at 10. So please do join us for that. In the meantime, thank you very much. Have a good rest of your day. Thank you very much, panelists.
Thank you, everybody. Bye-bye.